good evening, everybody, for this special session. And today is going to be an amazing session in terms of what are the 10 common mistakes that every investor makes in their journey, and how you should avoid them and how can you avoid them, right? So if you are ready to learn, just type RTL, ready to learn, in the comment box, and let's get started with this amazing session today. And just take notes. If you don't have a pen and paper ready, just go and grab it, because if you are able to avoid these 10 mistakes, you will be 90% through in your investing journey. So go and grab your pen and notepad. I'm just checking my again feed just to ensure if it is going correctly. Yeah, so I think the feed is also fine. All right, so let's get started with that note on this amazing session. I'll share my mind map, and that is where, we will go deeper into this topic. This is going to be ultimate learning topic, which you will be going through, right? So hope you are taking notes, and let's get started. So I'll be sharing my mind map. Just let me know once this is visible. Okay, let me just share this now. So I have a mind map, which I'll be sharing to you now. Yeah. All right. So once this mind map is visible, just type visible in the comment box if this is visible as well, so that I can understand you are able to see the mind map. Awesome. Thanks for confirming, guys. Yes. So these are the 10 topics we are going to learn today. What are these common mistakes that you should not make if you are somebody who is investing? And then I have something amazing for all of you, how to avoid them. So these are like solutions which you can apply if you don't want to make the same mistakes. And even if you have made those same mistakes, you will understand exactly what all things are stopping you, what are your pain points, and you should be able to easily overcome that. And last but not the least, I'll be also giving you a gift, which is a surprise. So for people who are staying till the end, they will get a gift from my end for spending time today, Friday evening. So all of you, if you are loving gifts, just type love gifts in the comment box. Yes. And let's get started with this note on this session. Yeah. So if you love gifts, just type love gifts in the comment box. So let's get started with these 10 common mistakes. So the first common mistake which every investor makes is called buying cheap syndrome. Okay, BCS, buying cheap syndrome. So when we get started in our journey, we always read a lot of books around, value investing, particularly all the Ben Graham stuff. And that is where we always think that, let's find something cheap. Okay. And in terms of cheap, what we always figure out is in terms of price. So most of the people end up into this trap, particularly when they are getting started. Okay. So first they will hunt for penny stocks. Okay. So they will think that, okay, something which is available for 5 rupees, it is cheaper, and something which is, available at expensive price, like 1,000 rupees or 10,000 rupees, that is expensive. How many of you have seen people doing it? Just type PS in the comment box, buying penny stocks in the market, right? So they will always think, 1 रुपए का है और कितना नीचे जाएगा, right? So that is called और कितना नीचे जाएगा syndrome. So when they see a small 1 rupee, 2 rupee, 5 rupee share, they feel, okay, downside is limited, so if it is 1 rupee share, I can lose only 1 rupee. Right? And if it is 5 rupee share, I can just lose 5 rupees. So that is where it is called or kitna niche jayega syndrome. And that is where most of the investor, when they start their journey, they end up buying into penny stocks. And it is not about price, because it is always number of shares of a company which determines the value of the company. Let me give you an example. Suppose I have a 100 rupee note, which is a company. And if I give you 20 rupees 5 note, okay, or I give you 1 rupee 100 coins, does that make any difference in terms of the total value of that company? No, right? But most of the investors don't think like that. They think that, okay, MRF share, it is like 1 lakh rupee share, it is expensive. But it could be just like 10 shares of 1 lakh and the total value is 10 lakh. And same with the same penny stocks, they might have created 10 lakh shares of 1 rupee each. Okay, so that's where it is very important to understand that it is not about the price, it is about the total value of the company. Okay, so that is the first mistake people make. Second mistake is they always hunt for a 52-week low stock in a bull market. What I mean by this is, people just see what is falling and they will just scan across the 52-week low and they will identify, okay, these are the companies which are forming new low. So it might be cheaper because they have fallen so much. But they don't look about the reason because of which that has fallen. It could be because the company is really going, very bad in terms of business. Okay, so somebody, if they tell you, okay, you buy Jet Airways shares, or you buy DHFL share, or you buy something which is not running at all, right? Sri Astu kind of company. Will you buy it? Right? There is a shop nearby in your colony, and that shop is not operating. No customer is coming there. There is nothing inside, and it is locked. And somebody tells you, you buy that for 1 crore rupees. You will not buy it, right? But people make the same mistake when this comes to investing, because it's our own bias which we are fighting with. How many of you agree with this? Just type agree in the comment box. So very important point to note down is, something which is trading at a 52-week low doesn't mean it is cheap. It could be because of genuine reason of business deterioration. Okay, so that is the second point to understand. Now, a lot of people do another mistake. So something which is falling continuously, they feel, it's a bargain. Okay, so I remember a lot of investors, still people ask me, Yes Bank, DHFL and all those kind of companies. So it started falling from 650 rupees, Yes Bank. And then it fell to, 200 rupees, then 100 rupees, then 50 rupees, then 30 rupees, and then 10 rupees. And what generally people keep doing is they keep buying the shares at each fall, thinking that they are getting it cheap. Okay, so avoid this symbol or the syndrome, I would say, buying cheap syndrome. So something which is expensive looking in terms of price, like 1,000 rupees share, 5,000 rupees share, 10,000 rupees share, could also be cheap, because you have to see that with respect to the fundamentals of the company. Right? So there is a first point in terms of the common mistakes every investors make when they just get started in the journey, most likely. Second mistake, as I said, averaging down losers. So suppose you have a company in your portfolio and it keeps going down and down. And what a lot of people end up doing is they keep averaging it. Okay, so it is like 100 rupees. Now it has come to 90 rupees, buy more. It came to 50 rupees, buy more. It came to 10 rupees, buy more. And after a few days, you will not find that company. It has gone. It has gone to zero, delisted. How many of you can resonate with this? Just type I in the comment box, right? Because if you just blindly look at price and don't know why this is forming a low, that is a dangerous situation. I'm not saying you should not buy it cheap. If you find that entire market is falling and it is genuine, fear in the market itself, it is perfectly fine. Something like last year, March COVID fall, if something has drastically fallen, it's perfectly fine to buy it. But if it is like one specific company like DHFL or Yes Bank, which is continuously falling, don't jump in without studying technicals or fundamentals. Whatever your process is, again, go back to your drawing board and see why this is falling. And sometimes, the price even keeps falling even before the news is out. So normal public might not even know that, this reason is there for the fall. So try to stay away from those kind of falls, and particularly don't average down those losers. And ideally, you should kick out those companies from your portfolio. It is difficult, but that is what will save you from disasters, right? So if you want to get saved from disasters, just kick out your losers. right? If you got this point, just type got it in the comment box. Yes. And we'll understand how to, crack these downs, and, what are the different biases which we have in our mind, because of which this happens, so that we are anyways going to cover. But it is very important to first understand what are the things which stop every investor in their journey, right? So that is the second point, which is there. The third point is booking profit too early. How many of you have seen a company in your portfolio which has eventually become 5x, 10x your your HDFC Bank or Pidilite or any such good company, which in your journey you might have bought it once in a life, right? So when you have started your journey, you might have bought it sometime, but you are not able to hold it for a longer period of time. If you are somebody like this, just put a smiley in the comment box. If you got this multi-bagger in your portfolio, but you are not able to ride it fully, right? So I'm sure a lot of you might have come across, even I have come across many times, right? So it is like very natural to every investor. So I'm not saying I am God and I've not done like this anytime. Still, we keep on doing it. And the idea is to learn from our own mistakes, our own biases, and overcome them, right? So it is very natural. And once we come to know what are these biases, that is where we go to the next level, right? That is where we break our own ceilings. So first bias when this comes to booking profit too early is, when the stock starts making new high. So say, for example, this company is trading at 200 rupees, and for 1 year it has got into 200 zone, and now it goes to 250 rupees, and it has formed a new high. Never in the history of the company it has formed, that high in the history, right? So that is where, if it is a 52-week high or an all-time high, what happens is we feel, yeah, oh, this has made a new high, now it is expensive, and let's start selling it, right? It is exactly opposite of buying cheap syndrome, right? So buying cheap, what we think is, if it has come to 52-week low, let's start buying it more. Exact opposite is here. When we find a company which is making a new 52-week high or an all-time high, and that is where we think, let's get out of it, it's like expensive now. But we don't think about how the business has improved. It could be because the business has improved so much that now market is rewarding it, right? So when you are taking the decision about exiting at a new high, just think twice. Why this business, why people are ready to pay, right? So think about other market participants, that why other people are ready to pay higher prices for this same business which was not doing anything. Okay, has something changed? Go back to your drawing board, go back to your fundamentals, and try to see this. Second bias around this is how much higher it can go. So if it has moved like quickly, doubled like in 6 months or 1 year, you might feel, oh, this has run up so much, how much more it can go, let me book profit early. And that same share can become 10x also within 5 years. How many of you can resonate with this one? So when you thought that, okay, now this is over, and that becomes like a big horse, and that keeps moving so much that you might not have even imagined it. Okay, so that is another thing which you need to focus. How much higher it can go? It can go higher 10 times, 100 times also, right? If really the business is playing out, if the business is changing gears, it can go so much high. So avoid booking, quick 20-30% movement, booking profit early. That is where most of the people, when the journey is just started, the rocket has just launched, people jump out of it, and that rocket goes to the moon also, right? So that make sure that you assess the business before getting out too early, right? And another problem with most of the people, thanks to your mobile phone, thanks to Zerodha and a lot of internet technology, almost free internet, the problem is being too active in markets, watching breaking news on business news channels. How many of you are watching business channels? Just type BC, business channels, in the comment box. When the market is is live, when the trading hours are there and you watch business channels. Just type BC in the comment box. Okay, I see a lot of people, Amaya, Dipesh, Simanchala, Eshwar, sometimes. Okay, you know what is the best gift you can give it to yourself if you don't want to get distracted and too much active in markets? Just stop watching business news channels. I have not watched business news since 5 years, and still whatever company I'm analyzing, if I need any information, I can easily get it. There are so many number of sources. When you start your research, you can get the information you want. Today's time and age, there is no dearth of information. It is about over information, right? So don't get distracted by all the things which, all the people in the business news wants to put it in your head. Just stay focused, and just focus on the companies which you are analyzing and which you are tracking, and have a system in place. Okay, if you don't have a system in place, you will get distracted by all the kind of news and information all around you, right? So it is very important to stay away from noise and being too active in the markets. I just see, once in a while what is going on, and my major research work goes during the weekend. I spend like 3 to 4 hours very focused. I see my screen, which is throwing me all the price volume action. I shortlist 15 companies, and then all those 10 to 15 companies which are coming in my watch list, I just see what is the news around it, and then next week I take action whatever is required. But never watch news channels on a real-time basis. It will just, make your mind too much active, which is not necessary. And this is again the point tying back to booking profit too early, because you will see all those fear factor noises around it. They will say band karo bazaar and whatnot, and you will end up selling when it is not required. Okay, how many of you will stop watching business news channels? Just type 100% in the comment box. Yeah, so that is the effective way to stay focused. Okay, and only when you stay focused in your investing journey, that is where your investing returns will start improving. Otherwise, they will just pump up what is required for them to pump up, and you will end up into booking losses too early. You will get fearful, and your emotions will, capture your mind. So the key to win in stock market is to stay away from your own emotions. Okay, so the key to success is to stay away from your own emotions. Be very, very focused, and analyze the news as it is required. Okay, so that is the third point. The fourth point is hope stories. Kabhi to kuch ho jayega, right? Sometime something will happen. Let me just keep holding it for long term. I am a long term investor, right? So they will see, a business which is not performing, they have in their portfolio, but they are not ready to accept that, because our ego comes in between, right? And what happens when our ego comes in between? We say, okay, no, something will happen, something good will happen, next year something will happen, and we'll hold it for 5 years, and it will keep going down and down, and that day will never come. Okay, so be very, very practical, logical, and very, very frugal when it comes to your decision making in investing. There is no room to hope stories in the market. Market will move irrespective of your position. It has to do what it has to do. It will not think that, okay, Eshwar is holding this, Amaya is holding this. No, I'll not fall. I'll wait. I'll start performing. Doesn't happen, right? Because performance is not in our hand. That is in the hands of management, in the hands of what kind of business model that company is having, right? If today you are sitting in a company which is making a DVD disc, okay, how many of you have a DVD player in your computer? Tell me yes or no. If you have it, just type yes. If you don't have it, just type no in the comment box. How many of you have a DVD player in your computer or a laptop? Most of you might not be having. Now think about a company in your portfolio which is making DVD. Is it fine to be in a hope that, okay, sometime people will start using DVDs? It is not going to happen. You wait for next 50 years, it is not going to happen. And that is where it is important to understand business model. Okay, so let's come to the mind map. Someday this will turn around syndrome is very, very harmful to investing. Don't stay in the hope story. How to go about it is avoid headwinds. Something which is headwind. Headwind is basically, when things are not moving in the favor. It could be a sector or it could be a company. What is the worst sector right now in the COVID environment where there are so many headwinds? Just type in the comment box. The sectors which you can think are facing so many challenges in today's COVID environment. What are those kind of businesses? Just name some sectors which comes into your mind. Real estate. Yes, because a lot of people are not buying, particularly commercial real estate. So never get into hope story that, okay, tomorrow commercial real estate will start working or not. Don't do that. Second, banks. Absolutely. What else? Restaurant business, right? Travel and tourism, all these business are gone for the toss. Hotels, yes, absolutely. So in these kind of businesses, if you see that, okay, someday something will happen, you will waste your 1 year 2 year of compounding and you will be at the same place, right? Let me show you some charts, right? So let me show you a chart of Nesco itself, right? So Nesco is into this thing, the IT park. Okay, so it is IT park and exhibition centers which it is catering to. And let me show you the graph of that. Okay, let's see this and you will understand what I'm talking about. So if you see this chart and let's open a 1 year chart, what has happened? What has happened to this business? Just write in the comment box. Has it given multi-bagger returns? No, right? Why? Because market is uncertain. So it made a high somewhere here. Let me see it. It made a high somewhere here in August, right? Some bit of rally, some breather. And then for almost a year, it has not performed. And now again, second wave, when it started coming, it has again started falling down. And there are a lot of businesses which are tech focused, which had a tailwind. What I mean by tailwind is they are favorable in this environment because people are working from home and a lot of things are happening online. So see the business like CDSL, see business like India Mart. What have they done? Right now, see the graph and you will understand yourself. In the same time period from August, from 350 rupees, it has doubled. And the business which was facing a headwind, they have not done anything. Let's take India Mart, right? So it is again a business where a lot of people in the offline world are coming to the online world. And see, from August itself, from 2,900 rupees, it has gone all the way to somewhere around 8,000 rupees. Right? So if we are in the hope story and we think, okay, ye to acha kabhi karega, and we buy businesses which are into headwinds, the chances are that most of the times you will not make money. Sometimes you might get lucky and you might come out as a hero. Okay, Vivek, see, I told headwinds and still, it was a value buy and I bought it and it doubled. That is fine. It is always fine to give away notional profit rather than making actual loss. Right? It is always important to make a actual profit. It is okay to give away notional profit, but we should not be making losses. How many of you agree with this? Because your capital is real, right? You want to compound your capital, and if something doesn't move for 2 years, you are better off putting in the FD, right? You will still get some 6% per year at least. Yes, how many of you had a bulb on moment? Just type bulb on in the comment box. Yeah, so that is very important. So bottom line is, don't keep holding a terrible business which is not performing, which is facing a lot of headwinds. Business like a DVD company, thinking that kabhi to अच्छे दिन आएंगे, वो अच्छे दिन कभी नहीं आएंगे, right? Your portfolio will keep bleeding. So what you need to do is understand business model. Don't get tied with the past winners. Like companies which are DVD kind of companies, these are past winners. Unka time tha, abhi chala gaya, right? So avoid old economy companies which are facing disruption and they are going to die in future, right? And find companies which are winners and growth companies of the future, right? Something like I showed you, right? So if something which is going to grow in the future, you are more likely to make money in those businesses than being in the hope stories, holding those companies where nothing is going to happen. Okay. Another problem in same format is high dividend yield trap. So a lot of people, they jump into companies which are giving 6% dividend yield, 7% dividend yield. How many of you have invested or you like companies with high dividend? Just type me in the comment box so that I can tell you what the problem is. Yeah. Okay. So a lot of you have said me, right? So think about this, if the company is earning money and it is giving out all the money back to the investor, what does that imply? It implies that the business is not able to grow. Okay. It doesn't know where to put that money for the growth. If you are a good business and if you want to grow, you need money to grow, right? It is another matter for companies like HDFC, AMC or CDSL, where they can grow even without putting the capital. That is a different story altogether. Okay. But if you find a low PE company with a high dividend yield, most likely it is a trap. Okay, so you can go through my Twitter handle. I've written a detailed thread. A lot of people, get swayed away by companies like, Coal India and ITC and all that. And they feel, they are getting high dividend. So it is good, they are getting some return on the top of that investment returns. But that is not happening because the share price also can fall, right? So if you are getting 4% dividend and share price falls by 10%, what is your actual return? It is minus 6%, right? And you pay tax on dividend also, right? So that is the problem, okay, which most of the people don't understand when they get started in this journey. Okay, so what I'll do is I'll share a detailed link of this thread. Go through this thread right now, just bookmark it. I'm just sharing on the comment box. And I'm also sharing on my Facebook live page so that other people can also, see this. So I'm just commenting on my Facebook live also. Okay, go through this thread. If you are not following me, also follow me on Twitter to learn more. But this is a detailed thread which I wrote on why high dividend yield companies are most likely a trap. Okay, so just go through it, and this will again help you to overcome your own biases. Okay, so just make sure you go through it. Next, let's come to the next point, which is on allocation. Okay, so a lot of people are smart, they do the right homework, they find the right company, and that also performs. So that company becomes, say, 5x, 10x. But what they don't do is allocate enough capital to that investment. So assume that you have 100 rupees worth of portfolio, okay, and you have put 1 rupee in a company, okay, so 1% of your capital in a company, and that has become 10x. What is the overall return you have earned on your portfolio because of that company? Just type in the chat box. Now, what is the overall return you have got on your portfolio because of that 10x? It is just 10% return, right? Because your 1% has become 10x. Okay. And other person, what he has done is he has just doubled his share and he has 20% allocation in that particular company, and he has not made 10x. He has just made 2x. What is the return on the portfolio? It's 20%, right? So 20%, and it has just doubled. So the same allocation, 20% return additional you have got. So who is better off? Person making a 10x return or person making a 2x return? Of course, your answer will be unanimous, right? Person making a 2x return, because wherever he was winning, he has put the capital. If you do not allocate to your winners, that is a even more bigger problem than finding a multi-bagger company in your portfolio, right? So that is what is important. It is just exactly opposite. And you should not keep adding capital to your losers. That is another way of doing it. Okay. So what I have done is, when I did a podcast, I have actually shared this entire thing. You can go through my podcast. I'll just share the link for all of you if you want to go through it. So it's called technofunda.co/podcast. And if you go through this, you will find the detailed 30 minutes podcast on why portfolio allocation matters and what you should do in terms of your portfolio allocation, right? So this is the link of that podcast. I'm also sharing on my Facebook live page, so that if you want to listen this, just spend 30 minutes of your time whenever you are free after this session. And I'm sure if you spend that 30 minutes, it will change your way of thinking when it comes to portfolio allocation, right? So if you will do this 100%, just type 100% in the comment box. If you will, listen to this session, which I've mentioned, just type 100% in the comment box. Yeah. So that is about the allocation. It is very, very important and critical thing when it comes to investing. And then, as I mentioned, market doesn't care. It doesn't care whether you are long or short about your position. So when you are wrong, just get out. Again, don't go into hope story. What a lot of people, what they do is, suppose they bought a share at 10 rupees and it has gone to 5 rupees, 50% down without any market correction. So it is probably a genuine reason why the company has probably fallen. And what most of the people will do is they will think that, okay, I'll not book my losses, although they know that company is bad, it is not performing, and they will wait for break even point. वापस 10 रुपया जाएगा तब मैं बेचूंगा, no profit, no loss, right? And they wait again for the lifetime, and probably they will not get the 10 rupees again. It might go from 5 rupees to 1 rupee and sometimes also 0, right? So don't have price anchoring in your mind. Price anchoring is again one of the worst thing to have when it comes to stock market, right? So when it comes to booking losses, if you are wrong, don't think twice to book the losses. I know it is very, very difficult. It is very, very painful. And I'll tell you how to do it in the last part when we discuss how to avoid them. But be very, very brutal when it comes to exiting your losers. Okay, so that is the 6th point. 7th point, again on same lines, falling in love, being emotional about a company. ये तो मेरे चाचा ने मेरे लिए ली थी. This company, this is the first share I bought when I started investing, so I'll never sell it. Okay, irrespective of what is happening. This is the company which I bought on my anniversary. Okay. And then again, people stick with sentiment in the names of the companies also. So something which is like your daughter's name. Say, for example, you have Rupa as your name of your daughter, and you bought Rupa company because it is same name of your daughter. With the no, this is like my daughter's same name company, so I'll never sell it. Right? So don't get into these biases. Recently that happened, there is this Bombay Oxygen investment company. And because there is so much of shortage of oxygen, a lot of people started buying it. Oh, this is making oxygen, without even understanding the business model of the company. People started jumping in. From 10,000 rupees, it went to 25,000 rupees. And if you go into the financials of the company, read the website, annual report, it's clearly written it has stopped producing oxygen cylinders. Since 2-3 years, it is NBFC, it is doing banking work, right? And people have just jumped in. How many of you have found this funny? Just put smiley in the comment box. And this is market for you. People are getting into these biases. Same way I remember when this Dabang movie was there, right? So Dabang 1 and 2, a lot of Salman Khan fans, they jumped into this company called Ashtvinayak, Sri Ashtvinayak. Today, if you go and search the name, that company doesn't exist. It is no more listed, right? And people thought, Sallu Bhai ka movie hai, this stock will double in no time. This is again one more bias which people have in their journey, right? So don't get into these kind of biases when it comes to investing. That is the bottom line. Okay, how many of you have got this point and will not do these kind of mistakes? Just I've got it in the comment box, right? So don't fall into these kind of traps. Don't be very, very emotional. Read at least about the company, what company is doing before investing, right? So that is the next point which I have to mention. That is in terms of next HDFC syndrome. So what people do is they always want to find a new multi-bagger. They don't want to accept what is already existing. Okay. And that is where again people fall into this trap. They keep hunting for new winners. Next HDFC Bank, next Asian Paints, next Pidilite, and they end up buying into Yes Bank. Next Titan, they end up buying into PC Jewelers, right? And you know what happened to all these companies. So if something is already performing, if something is really a market leader, and if you see a long runway to it, if it is really compounding in your favor, right? Don't live your, best heroine who is already performing and making movies to go into some new star who is just onboarded a train to Bombay, and you think it might be a next, Priyanka Chopra or somebody, right? If you already got Priyanka Chopra with you, no need to find a new Priyanka Chopra. Getting me? If you are getting me, just put a thumbs up in the chat box. Yeah. So make sure that if something is working, it is something is compounding. If you see a long runway for those companies, don't hunt for the next HDFC and all these stories when it comes up. Even if it might materialize, I'm not saying something will not materialize. You need to study it, that what are the ingredients, why it can become next HDFC, right? Don't fall in the trap of all the stories which people are floating around. The ninth problem is very, very common with most investors who are starting is no plan or exit strategy in place. So they will buy something, okay, I want to buy this, I bought this. They will buy something, but they will never think when to exit. And that is again the same problem when it comes to all these hope stories, because they don't know when to exit. They don't have a framework in place. Allocation, same thing. They don't have a framework when I should average up and when I should not average down. So if you don't have a plan in place, even before buying a company, it is a plan for disaster. So it is very important to have a plan, a strategy, a system in place, even before you buy any company. And I'll also share something in the gift which will help you to do that. Okay. So the gift which I told you, that will help you to take those kind of decisions. Okay. So that is very, very important. So have exit strategy in place even before you start buying it. If you don't have an exit strategy, if you don't have an investing thesis in place, you are not going anywhere. It is perfect recipe for disaster. Okay, so have a plan in place, have an exit strategy in place. And that is where, even in my journey, I like to blend technical analysis with fundamental analysis. And most of the technical analysis part help me give that at least early warning indicator that, you need to exit. And then I go back to my investing thesis. I go back to my fundamentals and see if things are all right, or it has got deteriorated. And then you don't be emotional about it. If something is not working, if you have analyzed it and your investing thesis has got breached and your technical analysis is also telling you that you need to get out, then the best thing for you is to get out, right? So there is no other option. You have to get out. Okay. Otherwise, gone, right? So the portfolio will keep bleeding. 10th problem, very, very common, which I should have kept it first place. But, most of the investor who get started in their journey, they want quick money, ek din mein paisa double ho jana chahiye, right? And if you have a framework in place, if you have a system in place, see, things will happen, but it happens slowly. You have to first perfect your kick. how you are able to do this, what is your system, have you fine tuned your system, what is your risk reward, have you taken care of your exit strategy, have you taken care of your downside, then things will start changing. But what most of the people, when they start journey into investing world, they do is they jump into intraday. Okay, same day 5 times ho jana chahiye, double ho jana chahiye, right? They get into F&O, and I've also done all these mistakes. I am not somebody who have not done it, and that's why I'm telling you all these, that don't make the same mistakes. I've learned all these things hard way, like blowing up so much money. Okay, so don't do this. If you are just getting started, if you are not full time, intraday and F&O is not for you. Understand that. If you are doing full time, you have practiced, you have achieved your system, you fine tune it, then also even only 5% intraday and F&O traders win. Other 95% people lose money. So don't play the game where the probability is not in your favor. Okay. So make sure that you don't do intraday if you are not expert into the field, if you don't know the game, if you are not doing full time. And don't quit your job for doing intraday full time. That is the worst mistake you will make in your life. Okay, so don't do that. And don't go into F&O. Don't take leverage. That is again the recipe for disaster. You have like 2,000 rupees in margin, you buy for 20,000 rupees. You have 1 lakh rupees, you buy for 10 lakh rupees by taking margin, taking leverage through F&O. Perfect recipe for disaster, right? Only thing as an investor we control is risk management. And if you take leverage, if you are into F&O, if you are going into intraday, it is very difficult to, control your risk. You have to be better at it, know the game, then only do it. Otherwise, it's not for you. Then, during these kind of bull market, a lot of people end up buying each and every IPO, thinking that, I'll make money in that IPO. That is again a myth, that IPO will give you money all the time. It will not, right? Why will a promoter sell you that company at that price if it is really cheap, right? See, sometimes they genuinely keep like 20-30% for investors. But if you think, double ho jayega paisa if I put in IPO, just give me a second, and I'll get from all the listing gains, then it's a problem. Don't get into IPOs. Okay, study them and then only get it. I'm not saying all IPOs are wrong. Okay, there are genuine companies which you can buy, but be careful. Don't get swayed about a lot of people talking different things in social media. Don't depend on tip, and particularly don't depend on the business news channel who are saying you subscribe to this IPO and do this and do that. Do your own study, see what is the business model, what is in for you, and then take that decision. Yeah, if you will do this 100%, just type 100% in the comment box, because if you are able to even avoid this 10th point which I have mentioned you, right, you will save so much of money for your family. You will not make any blunders, right? So that is very, very important. And why I'm telling this is because I've gone through this entire journey. It's not something like I'm just telling it from my head and just for the sake of this webinar, right? So I've gone through that path and I know what are the probability rates of winning. And if you are just getting started, you don't know the game, it's not for you. Okay. And very few people will tell you this, but I like to be honest and brutal. Okay. So that's how I am. And that is how I want to be. Okay. So next, let's understand how to avoid them. How many of you want to understand how to avoid these mistakes and what are the key reasons behind this? Just type BIO, bring it on in the comment box. Yeah, just type BIO in the comment box and let's get into this, right? So there are a couple of things which you can understand about your own mind, about our own mind, which will make you more aware. And if you are more aware, you will end up making lesser of these mistakes. Will not completely avoid all these mistakes. Sometimes you have to also pay tuition fee through the market, but minimize the tuition fee, right? So that is where somebody like me who has been into this journey, I'm in the game for 13 years now, And I've seen through a lot of these things playing out. Even in my mind, I've seen other people making these mistakes. And that is why I'm laying it out for you, so that you don't end up making the same mistakes, right? So the first one is speculation. Don't get into the game of speculation thinking, it's like a lottery. As I said, in intraday, double ho jayega, F&O, it will become 5 times. I buy some options, and it will happen 10 times, 15 times. If I lose that amount. Don't do all those things. Don't get into speculation. So even if I do blend of technical analysis and fundamental analysis, even if I take a tracking position, I take small entry based on the technical indicators and price volume action, I go back to fundamentals and research why this is happening. I don't speculate, right? And don't have a instant gratification. As I said, those 10, 20, 30% thing, right? So if you are just getting 20, 30% return, you tend to book profit early. So don't do that, right? So that is where avoid instant gratification. If something is compounding and working for you, let it work for you. And something which is not working for you, cut it immediately. That is the key, right? So let winners compound and have a delayed gratification. Something which is already working in your favor, add more capital to it. Let it compound even more with a higher capital. That is the key to make it big. So I have one company in my portfolio, which is Vinati Organics, right? So that I bought in 2009, December. I bought it for 60 rupees with bonus split and everything. It is now 50x. And I let it run. The reason I've made it big is because I have let it run. Right? It is as simple as it can go. And in the journey, I've also averaged it up. As soon as it started making new 52-week high, new all-time high, the business was performing well. They were launching new products. You keep adding your capital to those kind of companies. That is where you will make it big. Okay. So that is first. Avoid speculation. Know when you are speculating, when you are taking a logical decision. Second is avoid loss aversion. So most of the times when we are in loss, we try to run away from it. And it is completely natural to have losses when you are investing, right? It is game of probability. You will not be right 100% of the time. I would say even if you are right 50% of the time, and if you keep riding your winners and you keep cutting your losses when you are wrong, you are fine, right? Because your risk reward is in your favor. But the problem comes in when we are in loss, we keep averaging down and don't see what is the deterioration in the business that is happening. And even after knowing sometimes that business is not performing, it is not a good business, still holding it is a real sin. That is the last mistake you should be making. Okay. So if you got this point of loss aversion, just type LA in the comment box, loss aversion. So don't be averse for the losses. If you are genuinely making losses, cut it short. Think loss as a cost of doing business, right? If I'm doing a business, I need to pay taxes. It is like exactly same thing, right? To find your winner, it is like taxes you have to pay to the market. Okay. So it's a natural process. It is very natural to have losers in your portfolio. The thing that matters is what you do with those losers. That is what is important. Okay. Third issue is price anchoring. As I said, we always think, ye to 1000 rupees mein buy kiya tha. How can I add it for 2000 rupees? That is where you don't average up. But if the business has really improved, it has improved more than 2 times, then it is cheap to pay 2000 rupees also now, right? It's like, you have put in a fee. Say, for example, you got your kid, right? Suppose it's a boy or girl, whatever kid you have, and you have put in, say, 10,000 rupees tuition fee to that your son, and he has become a board topper, 10th standard topper. Okay. And now he is going into 12th standard and he's asking for 20,000 rupees fees. And you know that he will also top 12th standard. Will you pay 20,000 fees, or you will say, no, I paid 10,000 fees 2 years back. How can I pay 20,000 rupees? You will pay 20,000 rupees fees, right? Now he has also become topper in HSC. Now he is coming in engineering and he is getting admission in IIT. Now the fees is 1 lakh rupees for same person. Will you pay 1 lakh rupees or not? Or you will say, no, I paid 20,000 rupees in HSC. How can I pay more? Right? So you pay 1 lakh rupees for IIT also. Then he is getting admission in Harvard. Okay. And now the fees is 50 lakh rupees for that same kid. Will you pay 50 lakh rupees fees? Yes or no? Just type in the chat box. Yes or no? Will you send him to Harvard, or you will say, no, I paid only 1 lakh rupees in IIT. I'll not send him. You will send him. So same thing you have to do with your company. Okay. If you own a business and it is performing and it is asking for more price, and if you think it is like really doing good, keep flowering your winners. Okay. How many of you had a bulb on moment? Your mind just sparked. And remember this example every time when you think about your winners, right? And then you will be decoupled with the price anchoring. So never have that price anchoring. Okay. Always think about whether the business is improving or not. Fourth thing is looking for novelty. And that is where, this next HDFC syndrome and all these things comes into the play. We are, wired by, God to find new things, something interesting, kuch acha karte, kuch fun karte, kuch masti karte, right? And that is where we always don't look for the existing companies in the portfolio. We want to always find something new. And it is always fine to do a new research, understand new business, track them. It is perfectly fine. But don't just sell your existing winner just to buy something new. Okay. Somebody has given you a tip, or somebody says, ye to acha jayega, this is next HDFC, buy it, ho jayega. Right? Don't fall into those hope stories. So think first whether your existing portfolio, the companies which are there, are they good enough? And whenever you get a new idea, compare that new idea with your existing portfolio companies. And that is where I also have a process called business ranking system. And I share this with, advanced level of my community members. And it is like a complete process in which you can just select the drop downs and take the decision whether the new company which is coming in your portfolio that fits into the score or not. If it is a lower score, you eliminate it. Right? So I've designed an entire model around it in terms of how to take decisions for business ranking also. Right? So that is how you have to be very, very objective when it comes to decision making. And finally, the problem is having ego, that I know everything, mujhe sab pata hai. Now this company is gone, everything is gone, and people are not open to learn new things. They are like, just close, I know everything. And they have that ego. Somebody tells you this company has this problem. No, since it is in my portfolio, nothing can go wrong in my portfolio, right? So not being open to ideas, not being open to learning. And this is again a biggest mistake. If you are in market, you have to be humble. You have to constantly keep learning. If you don't learn, if you don't unlearn what market is telling you, nothing is going to happen. Otherwise, market will teach you with a big losses, right? So either be humble and learn from markets, learn from mentors, learn from others' mistake, or learn from markets in the hard way, right? And a lot of people otherwise also do. If they have knowledge, they don't implement it, right? So I have a lot of people in my community, they learn everything, but they don't have that confidence to implement all these things, right? That is again a problem, because knowledge without implementation is no knowledge, right? So you have to keep implementing, fine-tuning your system. That is where you will be able to overcome all these things, right? So these are, some of the common mistakes, 10 common mistakes, and how you can avoid them, right? And now it's time for gift. How many of you are ready for this? Just type ready in the comment box if you are ready for a cool gift. Since you are there till the end, I would like to respect your time and your decision to learn here. So I'll share a link, which is a template for analyzing a company. It's a really powerful template. And a lot of people, if you go in the market, they give this template for 4,999 and more. But since you are here, I'll be giving this to all of you for free. So let me just give you this link. It is technofunda.co/excel. I'll share in the comment box also. Just note this down, and go to this link, you will be able to download a template. Okay, this is a very powerful template. All the steps and everything is mentioned. And in the first section, there is a link to a YouTube video also, which will explain how exactly to go about, analyzing a company and screen the company. So everything is there in the first step. Go through each of the steps, how it is there, and then go through the video. If you need more help, it will guide you how to analyze the company, right? So how many of you are loving this? Just type loving it in the comment box, right? So just make sure you are downloading this. It is just a token of gratitude from my end, and for being all of you here. Really appreciate your time, and hope you yeah, it doesn't need login. It's you will get a email with a download, the attachment. So you don't need to log in anything, and there are all steps mentioned. So you need to probably create a free ID on Screener if you want to use it. But apart from that, it doesn't need any specific payment or any special access as such. Yeah, so that is it from my end, guys. And if you are not following me on YouTube, I'll just share a link of my YouTube channel also. I've taken a lot of amazing videos out there. So you can keep learning there. I already shared the podcast link. So if you are interested, there are like many useful podcasts which you can learn from. And you can keep learning that way along with me. Yeah. So that is it from my end. Hope you liked this session, right? How many of you loved this session? Just type in the comment box. If it was useful, just type useful in the comment box. And I'll share this link of my YouTube channel also. And make sure that you don't make this same mistake, right? So my intention is, for today's session, whatever time we spent together, almost 1 hour, is to not make you the same mistake, right? So my time is well spent if you don't make the same mistakes in your journey, right? So that is ultimate gift to me from all of you, if you don't make the same mistake which I've mentioned. And guys, this might look simple, but these are like really serious mistake. Most of people make it, right? So make sure you don't end up making the same mistakes. And thank you again for joining on this awesome Friday evening. Hope it gave you some positivity from all the negative news all around. So stay focused, stay positive, and keep yourself safe, wear mask, and keep learning. Bye-bye. Thanks a lot for joining this session. And if you are not in my Facebook group, you can just go to technofunda.co/Facebook. And you can even join my Facebook group if you are not still there. Yeah. So I keep doing such kind of Facebook lives on an ongoing basis, so that you can learn along with me. And this is totally free. You don't need to pay anything for joining my Facebook group. Yeah, it's invite only, but you can join this group as well. Yeah. So it is technofunda.co/Facebook. Yeah. So I'm just sharing this here. So amazing, guys. Thanks a lot, and keep learning, stay safe, and see you around next time. Bye-bye.